Silver just did something that hasn't happened in over 45 years. In January 2026, the price of silver, the same metal sitting in your jewelry box, embedded in your solar panels, and hidden inside your electric vehicle, hit $121.67 per ounce. That was an all-time record, a number that shocked even the most hardened precious metals veterans on Wall Street. And then, within just 3 weeks, it lost almost half its value. Yes, you heard that right. One of the most explosive and violent swings in commodity market history played out in real time. And right now, as we record this on February 17, 2026, silver is trading at around $74.65 per ounce, still down roughly 33% from that record high. So what happens next? Is this a historic buying opportunity, the kind people talk about for decades? Or is the silver bull run over? Today we break it all down with fresh data, real analyst forecasts, and hard numbers, including 3 major price targets for 2026: $88, $94, and the number that sounds almost impossible, $142. We are going to tell you where each of those numbers comes from, what has to happen for silver to get there, and what the smartest institutional minds on the planet are saying right now. To understand where silver is going, you first have to understand how we arrived here, because what has happened over the past 12 months has completely rewritten the rulebook. Let's go back to the beginning of 2025. Silver was trading at roughly $28.92 per ounce. That was already considered a decent price, respectable, steady, but nothing extraordinary. Most mainstream analysts at the time had silver in the low to mid-30s by year-end. What followed was nothing short of extraordinary. Over the course of 2025, silver climbed an astonishing 147%, rising from under $30 all the way past $70, then $80, then $100, blasting through price levels that analysts had said were years away. By October 2025, silver had set what was then its record high of $54.48, a moment that caused shockwaves across financial markets. But that wasn't the end. Silver kept going. Then came January 2026. As the new year opened with a surge of institutional buying, speculative momentum, and a flight to safe haven assets driven by geopolitical uncertainty in Washington and a weakening U.S. dollar, silver broke through its historic 1980 ceiling at $50 per ounce, a barrier that had stood for 4.5 decades, and kept sprinting higher. On January 29, 2026, silver printed its all-time nominal high of $121.67. The gold-to-silver ratio compressed to around 50-1. The world was watching. And then the violent reversal came. U.S. Treasury Secretary Scott Bessent publicly attributed the extreme swings to what he called speculative activity from Chinese traders. COMEX saw margin calls pile up. Retail traders who had piled in near the top faced brutal losses. And within just 3 weeks, silver lost nearly 50% of its peak value, settling back into the mid to high 70s range where it now trades today. That is the context. That is where we are. And now the critical question: is this a crash, or is this a consolidation before the next leg higher? Here is something that does not get enough attention in mainstream financial media, and this is arguably the single most important piece of the silver puzzle. The silver market has been in a structural supply deficit for 5 consecutive years. This is not a rumor. This is not speculation. This is data published by the Silver Institute and cross-referenced by Metals Focus, 2 of the most credible research bodies in the global commodities market. In 2021, the market flipped into deficit for the first time in years. Demand jumped to 1,112 million ounces, while supply lagged at just 1,023 million ounces. That was the beginning. In 2022, demand surged to a record 1,306 million ounces, creating the largest deficit on record at 272 million ounces. Then 2023, then 2024, then 2025. Every single year, 5 straight years of the world consuming more silver than it produces. The cumulative deficit from 2021 through 2025 has now reached approximately 820 million ounces. To put that in perspective, that is nearly a full year of global silver mine production. Gone, absorbed, not sitting in a vault somewhere, consumed by industry, by investors, and by the insatiable demand of the modern technology economy. In 2025 specifically, the Silver Institute estimated the annual deficit at around 95 million ounces, still massive, even as total demand dipped slightly. And here's the crucial detail. Global mine supply in 2025 came in flat at approximately 813 million ounces per year, barely budging despite dramatically higher prices. Why can't miners simply ramp up production? because of a structural constraint that most retail investors don't know about. Over 70% of all silver mined globally comes as a byproduct of other metals, copper, lead, and zinc mines primarily. That means silver producers cannot simply flip a switch and produce more. Their output is tied to demand cycles for completely different metals. This is why, even as silver prices have more than doubled, supply growth has essentially been stuck. Meanwhile, COMEX inventories have been drawn down substantially. London Metal Exchange silver holdings fell so sharply that spot prices briefly traded far above futures prices, a condition called backwardation, and lease rates in London reportedly spiked toward 39% at the peak, reflecting extreme physical scarcity. And then, in January 2026, China made a move that changed the game permanently. Beijing placed silver under an approval-based export licensing regime, treating it like a rare earth metal rather than a freely traded industrial commodity. This single policy decision sent shockwaves through global silver markets and was one of the accelerants behind January's explosive price spike. Now let's talk about the demand side, because this is where the story gets truly remarkable. Industrial demand now makes up approximately 59 to 60% of total global silver consumption, up from just 50% a decade ago. This isn't a temporary blip. This is a fundamental structural shift in what silver is used for and why the world needs it. Let's break down the three biggest growth drivers. Solar energy. In 2014, solar accounted for roughly 11% of silver demand. By 2024, that number had exploded to 29%. Solar panels consumed approximately 197.6 million ounces of silver in 2024 alone, representing nearly 1 in 5 ounces of global silver demand. And here is where it gets important for 2026. Global solar photovoltaic capacity is forecast to reach 665 gigawatts in 2026, supporting around 120 to 125 million ounces of silver demand from solar panels alone. The European Union has set a target of 700 gigawatts of solar capacity by 2030. China's installations continue to set new records every year. There is also a technology shift happening inside the panels themselves. The industry's move toward more efficient N-type solar technology is actually increasing silver intensity per panel, not reducing it. Scientists at the University of New South Wales have warned that solar industry growth alone could consume 85 to 98% of global silver reserves by 2050. Electric vehicles. Every battery electric vehicle contains approximately 25 to 50 grams of silver, between 67% and 79% more than a conventional internal combustion engine vehicle. Silver is used in battery management systems, power electronics, charging infrastructure, and hundreds of electrical contacts throughout the vehicle. The Silver Institute forecasts global automotive silver demand will grow at a compound annual growth rate of 3.4% between 2025 and 2031. By 2027, EV vehicles will overtake internal combustion engine vehicles as the primary source of automotive silver demand. By 2031, EVs will account for 59% of all automotive silver consumption. EV production in 2026 is forecast at 14 to 15 million units globally, adding a further 70 to 75 million ounces of silver demand. AI and data centers. This is the newest and perhaps most underappreciated demand driver. Global IT power capacity increased approximately 53 times between the year 2000 and 2025, from 0.93 gigawatts to nearly 50 gigawatts. Silver is embedded throughout the hardware infrastructure of AI data centers, semiconductors, power electronics, connectors, cooling systems, and smart grids. Governments worldwide, from the US to the UK to the EU to China, are treating data centers as critical national infrastructure and fast-tracking investment, regulatory approval, and incentive programs. Grid upgrades and data center expansion alone are expected to add 15 to 20 million ounces of silver demand in 2026. Put it all together, and you have a demand revolution that cannot be easily substituted, deferred, or replaced. Silver is not optional in these technologies. It is essential. And the world is building more of these technologies every single year. Now let's zoom out and look at the macro environment, because silver does not trade in isolation. It responds to what happens with interest rates, the dollar, and global risk sentiment. Starting with the Federal Reserve. After keeping rates elevated through 2024, the Fed made a pivotal shift in late 2025, delivering 3 25 basis point rate cuts in September, October, and December of 2025. That policy pivot was a major tailwind for precious metals into year-end. As of today, February 17, 2026, Markets are widely pricing in 2 additional rate cuts sometime during 2026, contingent on economic data softening further. The Fed is expected to hold rates steady at the March meeting, but the direction of travel is clear. Rates are heading lower. This matters enormously for silver. There is a strong historical correlation, approximately negative 0.75, between real interest rates and silver prices over the past decade. Simply put, when real yields fall, silver rises. When the cost of holding a non-yielding asset like silver becomes lower because rates drop, investor demand increases significantly. Then there is the US dollar. Silver is priced in dollars globally, which means a weaker dollar makes silver cheaper for international buyers and boosts demand. The dollar has faced headwinds from policy uncertainty in Washington, and as the Fed cuts rates relative to other central banks, downward pressure on the dollar is likely to persist through 2026. Geopolitical factors are also in play. Uncertainty around U.S. trade policy, tariffs, and international relationships has driven safe haven demand for both gold and silver. India, which saw silver imports surge approximately 44% in 2025 to an estimated $9.2 billion, became the world's largest importer of refined silver, driven by a combination of industrial demand, jewelry switching from gold, and speculative buying on Diwali-related seasonal patterns. Indian silver prices nearly tripled in rupee terms over the course of 2025. Bottom line on macro, the environment is generally supportive of silver. Rate cuts are coming. The dollar faces headwinds. Geopolitical uncertainty is driving safe haven flows. And the green energy transition is accelerating demand regardless of what the economy does in the short run. Part 6. The 3 price targets: $88, $94, and $142. Now we get to the number everyone came here for. The price predictions. And I want to be very clear before we go through these. No one, not JP Morgan, not Goldman Sachs, not Bank of America, can tell you with certainty where silver will be in 12 months. Markets are complex. Surprises happen. What we can do is show you what serious, well-resourced analysts believe, what conditions would need to exist for each scenario to play out, and what the risks are. We are going to walk through 3 distinct scenarios: the base case, the bull case, and the high-end blow-off scenario. Let's go. Scenario 1, the base case, $80 to $88. JP Morgan, one of the largest and most respected commodity trading operations on Wall Street, currently expects silver to average roughly $81 per ounce in 2026. HSBC's forecast ranges from $58 to $88. CME Silver Futures, which represent the collective expectation of professional traders in the market, point to a year-end average near $91. In the base case, silver consolidates in the $75 to $88 range for most of the year. The $69 to $70 support zone holds. Investment demand remains firm but does not accelerate dramatically. Industrial demand continues at near-record levels. The Fed cuts rates twice, which is already largely priced in. And China's export restrictions cause some tightness, but not an acute supply emergency. This scenario is not a loss. It represents silver holding a level that would have been considered extraordinary just 18 months ago. From today's price near $74, an $88 outcome represents roughly a 18% gain over the course of the year. Not exciting compared to 2025's 147% move, but solidly positive. Technical analysts place near-term resistance in the $80 to $84 zone and see $88 as a realistic ceiling for the base case if momentum does not accelerate. The bull case requires a few additional catalysts to fire simultaneously. CME futures traders have priced in a year-end target of $91.235, and analysts at Investing Haven and XS.com point to $94 as a logical extension if momentum continues. What gets silver to $90+ in 2026? A breakout above the key $82 to $84 resistance zone is the first trigger. After the metal's massive run in 2025, the $80 to $90 zone is described by analysts as the key battleground for traders in 2026. If buyers can push through that resistance on strong volume, particularly if supported by ETF inflows accelerating beyond the 15 to 20 million ounces seen in 2025, the technical setup points directly toward $90 and then $94. From a fundamental standpoint, the bull case is supported by the deepening structural deficit, continued solar build-out hitting new record installations, EV sales accelerating, and possibly a more aggressive Fed cutting cycle than currently priced in. Gold Silver's lead analyst Alan Hibbard is particularly bullish, expecting silver to trade above $100 as supply deficits deepen and industrial demand accelerates. He views 2025's explosive move as a long overdue repricing, not a one-off spike. Citigroup, in some of their more aggressive modeling, places silver in the $70 zone as a base, with the bull case extending toward $91 and beyond. WisdomTree's analysis builds on the thesis that investment inflows will accelerate as inflation expectations re-emerge and monetary tightening cycles reverse further. Now for the number that sounds almost impossible: $135 to $142 per ounce. Bank of America, in a report that made waves across the financial media, published projections in their strong demand scenario showing silver reaching $135 per ounce. In their rare stress scenario, which they define as combining extreme supply tightness with a surge of investment flows, their models climb as high as $309 per ounce. We will come back to that number in a moment. The high-end case requires a confluence of events. First, the 5-year cumulative deficit of 820 million ounces begins to bite in a way that is visible in exchange inventories, triggering panic buying by industrial end users who can no longer defer purchases. Remember, industries like solar manufacturers, EV battery producers, and AI semiconductor fabs cannot simply stop production because silver is expensive. Their demand is largely price inelastic. If physical shortages develop, they will pay almost any price. Second, a sudden acceleration in ETF inflows. Institutional capital inflows into silver-backed exchange-traded products surpassed 95 million ounces in just the first half of 2025, already exceeding the full year 2024 total. If a similar or larger wave hits in 2026, the physical market could tighten dramatically. Third, if China's export controls on silver, which began January 1, 2026, begin to cause measurable shortages in Western markets, we could see the kind of supply emergency that sends silver prices to levels that seem unimaginable today. Long Forecast, a quantitative modeling service, projects silver could reach the $148 to $162 range by late 2026 under their bullish model, extending toward $169 per ounce by September 2026. Meanwhile, Investing Haven's long-term model, built on nearly 20 years of precious metals data, also sees a path to triple-digit silver as a realistic medium-term outcome. Are these numbers guaranteed? Absolutely not. But are they grounded in real supply-demand analysis and credible institutional research? Yes, and that is exactly why they deserve to be discussed seriously. Let's pivot to the technical picture, because whether you are a fundamental investor or a trader, understanding the chart structure matters enormously for timing. As of today, February 17, 2026, silver is trading around $74.65. COMEX futures are at approximately $77.17, with an intraday range of $74.65 to $78.42. The 52-week range stretches from $29.12 at the low to $121.79 at the high, a reflection of just how violently this market has moved. On a short-term basis, the technical picture is mixed. Daily indicators are broadly reading bearish to neutral as the market digests the correction from the January high. This is normal. After a move of this magnitude, technical consolidation is not just expected, it is healthy. The most important support zone to watch is $69 to $71. This is where XS.com's analyst places what they describe as a bullish fair value gap combined with a strong order block demand zone. If buyers step in here in size, it establishes a clear floor for the next recovery leg. Below that, watch $65, $66. On the upside, the first major resistance cluster sits at $82 to $84. Getting above this zone, especially on strong volume and with ETF flow confirmation, would be the technical signal that the correction is over and the next leg higher is beginning. Above $84, the next target is $90 to $91, what multiple analysts describe as the next logical price test. Above that, $94 to $100, the 1.272 Fibonacci extension from the corrective low, and then the psychologically critical triple-digit level. The broader technical picture also includes one of the most bullish patterns technical analysts can identify, silver's 50-year cup and handle pattern that completed in 2025. Investing Haven's analysts have described the upward shift following this pattern's completion as the most powerful bullish reversal in history. Cup and handle patterns, when they play out over multi-decade timeframes, tend to generate sustained multi-year bull runs, not one-year spikes. The gold-to-silver ratio is another technical tool worth watching closely. Currently sitting around 50 to 55 to 1, down sharply from its peak above 100 during the 2020 COVID crisis, the ratio suggests silver has already significantly outperformed gold. If it continues to compress toward the long-term median of 50 to 1 or below, it is a signal that silver's outperformance relative to gold is structural, not speculative. No honest analysis of silver is complete without addressing what could go wrong. Here are the 5 key risks you should know about. Risk 1. Federal Reserve policy reversal. If U.S. inflation data surprises to the upside, particularly with energy or food prices, the Fed could pause or reverse its rate-cutting cycle. Higher rates strengthen the dollar and increase the opportunity cost of holding silver. This would be the single most damaging scenario for silver bulls. Risk 2. A global recession. Silver is not purely a monetary metal. It is deeply tied to industrial production. A significant global economic slowdown would reduce demand from manufacturers, construction, and electronics, hitting the industrial component of silver demand hard. Even during the 2020 COVID crash, silver briefly fell to $11 per ounce before recovering spectacularly. Risk 3. Chinese speculative liquidation. U.S. Treasury Secretary Bessent's comments about Chinese traders driving the January spike are worth taking seriously. If Chinese speculative positions unwind en masse, as appears to have happened to some degree already, additional waves of selling could push prices back toward the $65 to $70 support zone or lower in the near term. Risk 4. Thrifting and substitution. At silver prices above $60 per ounce, some industrial users have begun what the Silver Institute calls thrifting, finding ways to use less silver per unit of output. Solar panel manufacturers have reduced silver loading per panel through technology improvements. While this has not yet offset absolute demand growth, aggressive thrifting could slow the pace of industrial consumption growth. Risk 5. COMEX margin and regulatory action. Rapid price movements often trigger COMEX margin requirement increases, which force leveraged traders to sell positions. We likely saw this play a role in the January-February correction. A repeat scenario, where regulators or exchanges intervene to cool speculative excess, is a risk that cannot be ignored. So we've laid out the data. We've looked at the deficits, the demand revolution, the macro backdrop, the technical picture, and the analyst price targets. Now let's talk about direction. What do we actually think happens next? Here's the honest assessment based on all the data we have reviewed today. In the short term, the next 1 to 3 months, silver is likely to remain volatile and range-bound between approximately $69 and $84. The market needs time to digest the extraordinary moves of 2025 and January 2026. Institutional players who piled in at lower levels and rode silver to $121 are likely still exiting positions. That supply of profit-taking will cap upside in the near term. The critical line in the sand is the $69 to $71 support zone. If that holds, and based on the structural deficit and strong industrial demand, there is good reason to believe it will, then the setup for the next rally is being built right now, quietly, in the background. In the medium term, the next 6 to 9 months, the bias is upward. 2 Fed rate cuts are coming, most likely in the second half of 2026. China's export controls on silver are creating a slow-burning supply squeeze in Western markets. The structural deficit continues to deepen. Industrial demand from solar, EVs, and AI hardware is growing with every quarter. ETF inflows are expected to remain positive. A move back toward $85 to $91 in the second half of 2026 is what most credible institutional analysts are converging on as a baseline. That represents a gain of roughly 15 to 22% from current levels, a solid return by any measure. In the high-conviction long-term case, 12 to 18 months out, the fundamental argument for $100 and beyond remains intact. Gold Silver's Alan Hibbard is calling for above $100. Bank of America's bull scenario models $135. And if the physical supply squeeze intensifies, which the 5-year cumulative deficit of 820 million ounces suggests is increasingly likely, we could see one of those explosive, news-making moves that generates the kind of returns that build generational wealth. The bottom line is this: silver is not dead. The correction was violent and painful for those caught at the top, but the underlying thesis, the structural deficit, the industrial demand revolution, the monetary safe haven case, and the macro tailwind from falling rates all remain completely intact. The direction for silver in 2026 is upward. The question is not whether silver moves higher, it is how fast and how smooth the ride will be. Let's bring it all home. We entered 2026 with silver having just done something it had not done in 45 years, break its all-time nominal high and sprint to $121 per ounce. The correction since then has been dramatic, but it has not changed the fundamental story. Silver is the only metal on Earth that is simultaneously a monetary safe haven and an indispensable industrial commodity for the 3 biggest technological transitions of our time: the green energy revolution, the electric vehicle transformation, and the artificial intelligence infrastructure build-out. The global market has consumed more silver than it has produced for 5 straight years. The cumulative deficit now stands at nearly 820 million ounces. Mine supply cannot keep pace. China has restricted exports. COMEX inventories have been drawn down to historically tight levels. Analysts from JP Morgan to Bank of America to Gold Silver to HSBC are forecasting higher prices, ranging from the conservative base case of $81 to $88 to the bull case of $91 to $94 to the high-end scenario of $135 and beyond. As of today, February 17, 2026, silver sits at approximately $74.65. That is 33% below its all-time high. Whether that represents a buying opportunity or a value trap depends on your time horizon, your risk tolerance, and your conviction in the structural story we have laid out today. What we can tell you is this: every time in history that the silver market has experienced a structural deficit of this magnitude, every time demand has grown this explosively from technology sectors, every time the macro environment has shifted toward lower rates and a weaker dollar, silver has rewarded patient, informed investors. This is not financial advice. Always do your own research, always diversify, and always understand the risks before you invest in any asset class. But if you've watched this video to the end, if you've absorbed the data, the analyst forecasts, the technical levels, and the structural story, you now know more about the silver market than 99% of retail investors, and that knowledge is worth something. If you found this analysis valuable, please hit the like button, subscribe to the channel, and turn on notifications, because we are going to continue tracking this silver story with fresh data every single week. The next few months in this market are going to be anything but boring. Thank you for watching. We will see you in the next video.